why buy now? Obviously, with interest rates increasing earlier on this week, the RBA deciding in all of their wisdom to increase interest rates once again by 0.25%, heading into Christmas, obviously going to, bring back cash flow for a lot of families across Australia with mortgage repayments, etc. And slowing down this inflation, which we've seen continue to climb and to roll out. Interestingly enough, I was having a conversation yesterday, and one of the core reasons for inflation as it is services, service-based cost, which is actually coming mostly from overseas. So, higher interest rates are really not going to have an impact on that core element that's driving inflation. And I guess the RBA's thought process might be, well, we can't really control this one, which is really driving inflation, but let's just keep bringing the handbrake down onto the rest of the economy to bring that back, whilst it's, quite in check. So it's a very interesting take from the RBA. So the way that I'm thinking about this, is it a good time to buy property? Well, I firstly want to have a look at the timing, some elements around the time of the year, and then also interest rates increasing. And then I also want to look at property and residential property itself in answering that question. I think that's really important for us to do. Firstly, great time of the year to buy property. Generally, we get the best deals. When we look back over the year, some of the best acquisitions that we make throughout the year are in this period throughout December before Christmas. Obviously, in the couple of days before Christmas, sometimes you have troubles getting a vendor or a sales agent on the phone. But the deals that are done leading into Christmas are often the strongest of the year. And the psychology is a vendor might have had the property on the market for a couple of days, a couple of weeks, a couple of months. They just want to have it all completed, all said and done, so they can go and have a relaxing time with their friends and family over the Christmas New Year period and not have this property hanging over them. They know that if they can't get the deal done heading into Christmas, their conveyancer, their broker, their banks are all going to be slowing down and stopping, and the deal might not get done until February. And then what's happening then? All of this uncertainty. So we use that as a tremendous driver of leverage heading into Christmas. And as mentioned, off markets, on market, the longer they've been on the market, the better usually in that terms of a negotiation. We're really using that time of the year as that leverage to get the deal done and to negotiate very strongly and to move into the new year with that purchase. So we've got that coming up, and that's really starting heading into December and extending through to Christmas. So that's occurring anyway. Now we've got interest rates which have increased. And in the conversations that I've been having and the commentary that I've been reading, the odds are that this is the last increase in the cycle. Now, we don't have a crystal ball. We don't know what's going to be happening next year and onwards. But the high likelihood is, and this is just opinion, by the way, guys, the high likelihood is that this is the last interest rate increase in this cycle. Okay, so if you can afford to buy a property now, where interest rates are now, at say have a $500,000 pre-approval, then there's a very strong chance that if you can afford that property now, and you understand the cash flow position of that property now, and it's generating, a reliable and good, strong rental yield, this is as bad as that cash flow is going to get. And it's going to potentially, as interest rates come back down over time, cash flow is only going to get better. So you've almost got a known quantity. If the property is ticking the boxes now, if the ROI is stacking up now, then it's potentially only going to get better from a cash flow perspective. You've now got mortgage pressure. As interest rates increase, you potentially have more and more mortgage pressure. Is that going to cause a correction? Is that going to cause a slowdown? Not necessarily likely, which I'll talk about in a moment about the reasons why there, but there may be the odd vendor which you can really negotiate the eyeballs out. There may be some distress in some vendors, not enough to cause a correction or a downward swing, but the odd mortgage holder may be having some distress, and combine that with heading into Christmas, we may be able to really capitalize on that. So buying with a floor established, where interest rates necessarily are most likely only going to be going down. so our cash flows are getting better, and then really capitalising on the time of the year and potentially those distressed vendors to get a really good deal. We want to buy the dips, guys. We want to buy low and revalue or sell high, and this is an extremely compelling opportunity to do that. So I'm really liking the environment this is creating. Now, of course, I'm talking at a macro level now. This is Australia-wide. We're buying one property in one street, one suburb, one LGA, one state. So we get very specific with this. So, we can control the variables. We're buying in areas that are really growing and going ahead. But at a macro level, at a psychological level with Australians, what we're going through, I think the factors are working with us, right? Buy when others are fearful. That's the adage that we live by in property. And this uncertainty, well, it's probably a good thing from this week's interest rate rises. It's created more certainty because it's far more likely that they're not going to go up again, okay? So if anything, we can move into the new year, move into the Christmas period with more certainty and more comfort. Now, why buy Australian residential real estate right now? So I wanted to refer to this slide because we have a confluence of factors that are pushing inwards onto residential property, and they are all amplifying each other. It's a very powerful dynamic that we are seeing at the moment. It's not obviously applied across the country in a very even fashion because we've got state governments and cities, LGAs, really pushing and pulling it every time. A good example of that is the Victorian government, state government, seem to be very anti-investor. So we've had, COVID, lockdowns in Melbourne. We've had oversupply in Docklands in the inner city area going into COVID. We've had one thing after another, which has really caused a big handbrake on investment returns in Melbourne for some time now. And now you have a state government there which seem to be really anti-property investment. And I did see a statistic in the last week of 1/3 of property investors who own properties in Victoria are considering selling based on this new legislation. So that's a large raft of people potentially exiting the market. What if you already own properties there in Victoria? That's probably a good question. If you own, generally I've always, biased towards retaining an asset if it is an asset. But when we're trying to navigate building a portfolio and the banks are saying no more lending because of debt to income ratios, etc., there may be arguments for selling down a Victorian portfolio and distributing it back out across the country. So I'm getting a little bit sidetracked there, guys. Victorian government, basket case in terms of their approach to investors and really impacting the investment landscape in Victoria. If you own regional Victorian property, we are still looking at certain locations for regional Victorian property. We've got localised dynamic that is extremely strong and it's extremely compelling, but we are fighting against this legislative changes that are coming through Victoria. So definitely, Melbourne Metro is stay away from. Regional Victoria still has a lot of potential. So, we have to take this why buy now approach with a grain of salt. We still have state governments that are fighting against what is going on in the investment space. Queensland tried it. They're introducing land tax and looking at your whole portfolio, even if most of it was in New South Wales or elsewhere, to assess land tax assessments. But then they wound that back because it was very unpopular. And they realised property investors serving a purpose. They are providing bottom-up or serving the bottom-up demand. Okay, property investors are putting rental stock into a market which is critically needed, generally across the country at the moment, and especially as interest rate rises, you might have the first home buyer sitting on the fence slightly. Well, investors are providing a critical mass of rental properties for these people to live in, and that's evidenced by extremely low, record low vacancy rates now with no hope of improving, which we'll see in a moment, and rents still rising extremely quickly across the country. When you look at Brisbane, Sydney and Perth, we've got dozens of suburbs with 2, 3, 4% rental growth per month for this year. Okay, that's extremely high. So we have bottom-up demand from the rental side of the equation, and that's not going anywhere soon. If anything, with the anti-investor sentiment in places like Victoria, this is only going to get worse. So what does that mean? It means that our rental returns, vacancy rates, the sources of income for our investments is potentially safeguarded, and if not, going to become more secure over time. So we've got extreme bottom-up demand for housing, especially on the rental side of the equation. You combine that with limited supply. Okay, so we've got some markets that we are looking at. Take Perth, for example. It's growing extremely quickly. They're having to revise the overseas migration numbers because they can't keep up. And there's no houses being built, or very few houses being built. You have you look at the papers every week, and there are more and more large builders going bust, and it's still occurring. And every subsequent builder that goes bust are not being replaced. Properties are not being built as they should and on time. Nathan made a comment last week when you were down in Hobart there, sir. We bought a property with you, or for you or with you, over in WA recently. And when that was insured, when the valuation came through, the replacement cost for that dwelling, and you might need to correct me on this, was more than the actual dwelling plus the established dwelling plus the land cost in total. So we've got a case for Nathan and his property that if it was to burn down, it would cost more to replace that established dwelling than he paid for the entire dwelling and the land. So you're looking at like this, like the way that I'm looking at that is, well, the land's for free. So there's a large price disparity between established and new housing, and that gap is not necessarily going to close. So when you have these gaps emerging in our market and you don't have this supply at the top end, it's really, we're not having new builders popping up overnight. This gap is not going to decrease downwards. The gap's going to close from the bottom up. Established dwellings, we're going to have more demand on established dwellings, and this price disparity is going to close. And that's the thesis that we've been looking at. We've seen this on the ground as evidence in the key markets that we're looking at throughout 2022. This hasn't changed. This was our investment thesis heading into 2023. And if anything, this has actually got worse. These conditions have got worse nationally and applying even more pressure onto established rent-to-buy, scarcity-driven markets. So this is the key here, guys. We're trying to target these markets which have extreme rental demand at the moment. You know, you've got new transport, you've got new jobs, you've got population growth, you've got all these wonderful things. They are creating this demand, and it's transitioning from rents first into buying later. And we don't want to hold a market in a market that's just full of renters long term. We want to find a market that's transitioning from renters to buy. And the pressure is transitioning from rent to buy. And that's the secret sauce. If anything, nationally, this dynamic has even become more powerful for us in the last 12 months. So that's a very strong, compelling reason why buy now, why buy into 2024. When you combine that with Christmas and we combine that with a little bit of distress from interest rates increasing, and cash flow will only necessarily get better if we assume interest rates will only decrease from here, then it's an extremely compelling proposition going into 2024. Now, the other side of this equation, the top-down demand. We have a transition away from commercial. We've had yield compression, yields evaporating in the commercial space, 7-8% net yields, now down to 4-5% net yields, 6% if you're lucky. I saw a shopping centre purchase recently for one of our competitors, 6.4% net yield, when traditionally I would expect that to be 8, 9, even 10% on that type of asset. So you've had tremendous yield compression in the commercial space. Okay, people are really scratching the sides of the barrel there to try and find quality stock in the commercial space. Far lower turnover of assets. And you have a lot of commercial investors spooked because of what's happening where they've been squeezed with interest rates. So when commercial used to be a beautiful cash cow for us to enter into, interest, it's not removed from interest rate rises. As interest rates have increased, the margin and the cash flow positions of these commercial assets have well and truly been squeezed, and the margin has become very fine. And not enough, very importantly, not enough to justify the risk of entering into these commercial assets. So you might look at a commercial asset and you might put into your spreadsheet 3-4% capital growth, and you might put into your spreadsheet, slightly positive cash flow position based on 60 or 70% loan to value ratio, but you're not looking at the risks associated with the industry or the tenants in those assets. It has to be a wider risk-adjusted return. And the conversations I've been having across the board with high net worth, family office, these are people who have made hundreds of millions, if not billions of dollars. Some of the rich listers in Australia who own large commercial assets in, Victoria and New South Wales are looking at diversifying very strongly into residential real estate. They are looking at spreading their eggs out of commercial because the risk-adjusted returns are just not there. So we have this top-down demand where you have large buyers. We've been doing work here in the funding space, in the acquisition space, from these large buyers coming into residential property and away from commercial. So when you combine all of this together, it is creating a very strong opportunity for established, very importantly, because we are closing that gap, that price disparity to new homes. We have a rent-to-buy transition in the right markets. That's a very positive thing that generates extreme high capital growth, and that's what we've been able to generate very routinely since 2015, that strong 17.7% compounding capital growth, because we've been able to find these rent-to-buy markets. You generate the capital growth from the transition from rent to buy, and then you hold that asset in a buying-focused or owner-occupier-focused market that have longer tenure times, lower security. So as those investors as those renters are staying to buy, it increases the owner-occupier levels, and we have the best of both worlds. On entry, we have outstanding high capital growth. On the back end, mid to long term, we now own that property that's gone from an investor type suburb into an owner-occupier buyer suburb, and that comes with higher scarcity, higher tenure times, and then increased capital growth on the back ends with that decreased stock. So we have this bottom-up demand and the top-down demand all combining to create a very compelling opportunity going into 2024. Those of you listening, love to hear your thoughts, comments down below. Let's make this a discussion because I think it needs to be. Any feedback, any things that you'd like to add, let me know.